As per the Economic Times, over 6 vehicles priced above rupees 5 million were sold every hour in India in 2024. Of course, buying luxury cars, luxury real estate, and luxury accessories may not have been possible for majority of Indians. But when it comes to buying stocks trading at steep price to earning multiples or ones offered at steep valuations during their initial public offerings or IPOs, Indian investors did not hesitate in 2024. Also, quick gains on even the riskiest segment of stocks further encourage investors to speculate on them. Newbie investors who entered the stock markets after the market crash of 2020 have yet to see a prolonged phase of market correction. So, very modest attempts at stock selection have yielded superb returns over the past 4 years. But at the cost of being spoilsport, I must warn you that the party is about to end soon. There are too many risks to not just valuations but also to earnings growth and quality. More importantly, with both corporate profit margin and market cap to GDP near historic peaks, it may take a lot for stocks to command even higher PE multiples. Having said that, businesses that show a meaningful path to value creation through innovation or diversification could be the ones to withstand any earnings or market turmoil better. Interestingly, ex-MD and CEO of Kotak Bank, Mr. Uday Kotak, shared a 10-point roadmap for India's growth in 2025. The roadmap calls for the ROTI or return on time invested approach to seeking corporate growth. In other words, it advocates for relentless productivity in the workforce. If you ask me, equity investors should take Mr. Kotak's suggestion much more seriously. Speculating on quick returns on bad or overrated stocks could prove to be extremely detrimental in 2024, especially in a year when macro variables such as inflation, interest rates, and geopolitical concerns are set to act as headwinds. Therefore, looking for quality businesses that rank high on earnings productivity and holding them for the long term could be the recipe for ROTI stocks in 2025. This also reminds me of a pertinent advice given by veteran investor Professor Sanjay Bakshi back in 2012. Professor Bakshi's advice was simple and extremely relevant to markets that seem to be pricing perfection. Instead of earnings or book value, he advised investors to evaluate the return per unit of stress. According to Professor Bakshi, once you start incorporating return per unit of stress in your investment thinking, the trade-offs become obvious. You would start settling for only those stocks which offer a satisfactory return per unit of risk. Also, an investor would intuitively avoid stocks which offer high returns per unit of financial risk but low returns per unit of stress. Once relatively low risk stocks start compounding over the years, the time invested in the stock market will automatically move up. Plus, the ROTI approach could limit the downside risk to stocks in the event of a near-term market crash. The problem is that current valuations far exceed the economic potential and earnings growth prospects of majority of Indian stocks. So, stock prices may not move in sync with the volatility in the economy. Also, steep valuations either follow good earnings or precede a slowdown. So, loading up on stocks from any sector, corporate group, or theme without ascertaining the intrinsic value of individual stocks is fraught with risks. Therefore, take a good look at the factors that cause a higher unit of stress in stocks, as I've told you before, and use the Equitymaster screener to eliminate businesses that have fared poorly on core fundamentals in recent years. And start your investing journey of 2025 with the resolve to stay invested in businesses that can deliver the desired returns on the other side of the market turmoil. Hope you like this video. Thanks for watching.